Hi and welcome to today's video. After covering Aether in depth in my first video series of AI Frontier, now on my latest video I am focusing on render, which is finding its reach in rendering and at recent times compute tasks. So without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice, I'm just one person with a microphone, always do your own research. What makes this protocol very interesting is that it enjoys support from big names like Ari Emanuel, which is connected to Endeavor and UFC, people related Mike Winkelmann and Brendan I, creator of JavaScript, among many others. Now jumping to the price, we can see that it currently trades at around $2.4 per token, and if we compare it to early offerings from 2017, which went from $0.25 per token, we see that early investors gained 10x on their investment, which is not bad return on investment at all. Focusing on chart, currently we can see the token is off 80% from its all-time highs, which is the case with many other altcoins. One of more important developments was their decision to move from Ethereum and Polygon to Solana, driven by its speed and lower costs, which support render long-term vision. Now turning to structure, it is designed pretty straightforward. We have creators, which are end users like artists, visual studios, etc., and node operators, which are the ones that have an GPU resource to offer. On the right, we can see example how specific GPU models score in render ecosystem, which give node operators an idea what type of rewards for their offerings they can expect. For creators, they can choose based on available tiers, from which two are currently available. Paying in per hour of rendering, we can see the lowest prices start at just €0.25 and then increasing based on how fast you want your project to be made. Tier 1 is reserved for trusted partners and it is still to be released. Now compare this to centralized competition, which lowest prices start at approximately $2. And you can already have a point where networks like Render have their shot. Also, what needs to be taken in consideration is that centralized competition like Amazon, Google is focused on large scale, which makes it tough to adapt to smaller players. So this is also additional advantage for networks like Render and Aether, which I discussed in my last video. On the other hand, if AI truly is on trajectory to reshape our future, global demand for compute will only accelerate, likely far beyond the capacity of existing centralized infrastructure. In that environment, efficiency and accessibility become key, and Render's ability to harness underutilized GPUs and make them usable throughout the centralized marketplace could secure its place in ecosystem. In short, even if Render never overtakes centralized competitors head-on, its role as a complementary layer is still alive. Unlocking idle compute and routing it where it's needed may prove that it's just valuable in the long run. There are a lot of different projections for total addressable markets. One which I'm showing to you is projecting growth from 4 billion to approximately 12 billion by 2030, but also there are much more optimistic projections going up to 50 to 60 billion dollars. This is quite nice to know as to understand if Render currently pricing from market cap perspective is attractive or not. So if we take current market cap of Render, which is approximately 1.3 billion, and we see that by 2030 total addressable market is around 12 billion, we see that current market cap of Render equals 1/10 of total addressable market. Some of you might see this as cheap, others as expensive, depending on how much total market cap Render obtained by 2030, especially when including other players not only from decentralized but also centralized world. Now on important parts of the system operating, burn and mint equilibrium. In simple terms, it is a way for economy based on Render token to find equilibrium. So every used token by creators is burned and minted for operators minus fee. Also, if there is no enough demand, there are additional emissions, incentivize operators to stay on the network. Imagine, network normally burns around 10,000 renders per month. That's equilibrium, where supply stays steady. If usage grows, for example, to 15K, and 15K are burnt, supply shrinks, pushing the price upward. As Render becomes more valuable, fewer tokens are needed to pay for the same service, pulling the system back towards balance. Reverse also works. If only 5,000 renders are burnt and more are minted than removed, supply grows, price falls, and more tokens are needed to buy the same service, again guiding the system back to equilibrium. Now, during early phase, this mechanism has additional benefits like rewarding creators by returning back a percentage of their spent render to incentivize them for further work, increasing network activity. From node operators, there are two categories of receiving rewards. Primary being for completing jobs requested by creators, and second one is related by constant availability. For those that watched my Aether coverage, get the grasp of some similarities between those two protocols. So they also receive part of the rewards by keeping their GPUs online the whole time. Another way in which you can earn render tokens is if you are a liquidity provider. Now, if we focus only on burn, which suggests demand for the token, and emissions, which are there to keep network going in its early phases, and what we want ideally to see is that amount burned is higher compared to emissions, which will be visible as protocol matures by passing years, as emissions are programmed to be reducing by each passing year, as shown by a graphic below. For example, currently, at recent report in June 2025, we can see that burnt render supply is smaller compared to monthly emissions, which puts selling pressure on the token itself currently. One thing that is nice, however, compared to Aether, for example, is that 80% of total supply is already unlocked, so vesting pressure from remaining tokens is much smaller. Now jumping to some statistics from this protocol, although I couldn't find data for total revenue, we see the following. Total frames rendered crossing 60 million, with total nodes since exception equaling 5,600. As I mentioned before, that render has 80% of unlocked supply, which gives some positive aspect compared to the Aether. Another positive aspect that render has approximately 1.6 billion fully diluted market cap currently, while Aether stands at 1.2 billion, which is also another aspect which makes render looking cheap compared to Aether. Returning again to emissions and burn tokens, total current burns are just under 750k tokens, while total emissions equals approximately 13 million. That's almost 12x higher than the total amount burned. As shown in the bottom left diagram, emissions during epochs 1 to 13 were 760k approximately, but were later reduced to 492k tokens, a change that aligns with the adjustments we have seen in government's proposals. As mentioned before, node operators are rewarded based on their completion of the tasks and availability. Based on the recent stats, nodes have been receiving around 15k render per week for completing rendering tasks, plus just under 3k render for availability. Converted to USD, that's about 43k per week. Scaled to a month, this equals around $172k in gross revenue. Of course, operational costs such as servicing, hardware depreciation, and electricity must be deducted, but overall it represents a meaningful income stream for operators with strong GPU setups. Now to conclusions, Render Network is one of the most established projects in the decentralized compute space, with clear traction in both community governance and real-world rendering output. Its 1.6 billion fully diluted market cap puts it in line with mid-cap tech startups, but the TAM analysis suggests meaningful upside if it captures even a modest share of the projected 12 to 50 billion GPU cloud market by 2030. Risk lie in execution and competition, emissions adjustments, shifting incentives, and the reliability gap versus centralized giants could limit potential adoption. Yet, the counterweight is that global compute demand may outstrip centralized capacity, creating a natural niche for decentralized platforms like Render. In other words, Render is not a guaranteed category winner, but it doesn't need to be. If it secures a durable role as a complementary layer in the GPU economy, its long-term value could be significantly higher than today. That said, it's important to recognize that Render is still an altcoin Depin project, and history shows how low such tokens can fall in bear markets. At today's prices, at this stage of the cycle, I personally wouldn't buy. However, during the next bear market, it's definitely one to keep on the watch list, especially as the compute space matures and new developments unfold. Okay, this is it for today's video. If you want to check full deep dive of this topic that I described today and spoke about, check my Substack. Also, I have other in-depth topics there. Also, if you want to check my daily updates and market insights, feel free to subscribe to my X, and for more educational content, check my website. Links for everything will be in the description of this video. Okay, this is it. Like and subscribe as a sign of support, and see you in the next video. Bye.